So I wanted to start this video and just talk a little bit more about U.S. stock ownership annual trends, which is basically like for Americans, it's like how many people have been investing in stock. And you can see here that the graph is just about linear, about like the same. And it's basically between 50 and 60% or so of people have their money in stocks. Pretty much the same for the past 25 years. Well, I guess this goes into 2020, but past 20 years or so. Now, if you really think about it, that means that 50%, like half of everybody, they just don't invest. Now, I used to just feel so sad for those people who didn't have their money in stock, especially when the stock market was going crazy. Since 2008, when it was at like $900, the best time in the history of the market, it went up to almost 6,000, like 6 times higher. Like people who had put the money in the stock market, they were just making so much money. It was like doubling and then doubling again, and this like they were making all this money when you had all these people sitting on the sidelines because they were too scared, or they told themselves they had to do more research, which they never did, or they told themselves they didn't have enough money, but they did, or they were just like, oh, I'm just not gonna invest, and I was like thinking to myself, well, what are the percentages of people, like who's investing and who isn't? Now, Gallup did this poll called U.S. stock ownership by subgroup. And what they found is that people who had household incomes of less than 40,000, which could be called poor people, okay? You can see here 29% were investing. So it's like not nobody, but 30% is very small. So 30% of quote-unquote poor people were investing. Now, then they wanted to go by graduation, education, and they found people who had high school education or less, okay, that was 41%, compared to people with more education, 82%, which makes you think that people with more education who are smarter know that investing in stock like FXAIX, the S&P 500, is the smart thing to do. They could say call that the smart money. And what I forgot to mention is household annual income, 100,000 or more, rich people. Guess what percentage of them are investing? 84%, which is like most of them are investing, okay? The rich people, the people with higher education, doesn't mean they're smarter, but they just have more education. And then let's go by age. 18 to 29, the youths, the youngsters. Let's guess what this is. Okay, 41%. Now, personally, I thought people under 30 would be like 5 or 10%. However, when you jump up to age 30 or more, right here, guess how much percent this is? Okay, 67%. So that means once you hit age 30, it's like way more people. What is that to 20? So like 20, I don't know, like 20, 30% more people, I'm not that great at math, are investing, because when you get older, you get wiser. You're less into partying and just spending money. You realize the value of money. You want to save. You want to build for your future when you get older. Now, studies, they're always doing like men and women. It's about the same. And then they've got one that I really didn't want to mention, but I might as well. Based on race, this study is saying that white people are at 67 and people of color are at 49. Who knows why that is, but it's just part of the study. But from this study, what you should know is that people who are 30 years or older, much more likely to invest. People who have more education in terms of postgraduate university, much more likely to invest. People who have more money, their higher income, much more likely to invest. And so if you think to yourself, well, actually, I don't have that much money. Actually, I just went to high school. I don't have, this formal education. And actually, I'm under 30, right? And so I'm in the low category for investing. But you can break out of this mold. You can join the winner's circle, the winner's club, which is there's people who are investors, like me. And then there's everyone sitting on the sidelines as the stock market is going up. They are not participating in the winnings. Now, I'm not telling you that the stock market will always go up. They say that every 10 years there is a crash. Okay, in 2008, you can see it crashed, big one. Okay, in 2000, you can see there was a big crash. All right, now it looks like here from 1984 to 1992, 6 years. See this? It doesn't look very exciting in those 6 years. Didn't go up that much, right? So I'm not telling you that, it's always going to go up 6 times like this. No way. It can crash. It can go down. It can, sort of not go up too much, whatever. But what I want you to know is that if you can break your fear of investing, and you can take some risk and know that, it's a roller coaster. It can go up, it can go down, but over the long term, it's going to be going up because you have faith in the U.S. economy. A lot of these companies are doing a lot of business internationally. Coca-Cola, medical companies, Microsoft all over the world. And then just having faith in capitalism. When I think to myself, I go to the Apple store, and I see a car on the road. It's like when someone's buying an iPhone, I'm making money. When someone's buying a car, I'm making money. When someone's popping a pill, and they've got the pharmaceutical companies in the S&P 500, which is what I have, I'm making money. And people will always be buying stuff, using services, using products. Companies will be making money. It'll be compounding. And just a little bit more about the S&P 500, if you're curious what that is. These 500 of the really large public American companies, they don't just stay there forever. I think maybe there's since the S&P 500 first started, there's 82 companies that have actually kind of stayed forever. But a lot of companies like Harley Davidson, boom, they got dropped. And other companies, when they start losing money and underperforming, there's this board who manages the S&P 500's, tracker fund, Fidelity, FXAIX. It's actively managed, even though it's considered passive investing. But there's a board of people, and when companies do bad, they drop them. And when companies do well, like Tesla, it was big news, they add them in. So it's, every quarter, they're always considering if companies need to be dropped or added, right? And they're really smart people, professionals, they do it for you. So the big problem with buying individual stocks, like if you were to have bought Macy's, at some point Macy's was going up, 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 up. But who's going to be like, yeah, I'm going to sell it? People are like, I want it to go up more. And then what happens? It starts going down, 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 down. And the ship's starting to sink. And people are like, well, maybe it'll go back up. And it goes down. Maybe it'll go back up. And it goes down. Maybe it'll go back up. And it goes down, down, down. And you never know when to sell it, when to buy it. Because you just get really emotional as a human. You don't really know. So buying individual stocks It's really risky. You don't know when to buy. You don't know when to sell. You don't know how much to buy, how much to sell. And there's other problems as well with individual stocks, which is like, are you a professional investment advisor? Is that your career? Do you spend hours and hours a day and like everything about these companies? Most people don't. They barely do any research. They're not a vice president at Microsoft with inside information and like they know when Microsoft's going to release a new product, the stock's going to go up, and they know how the revenue and this and that. They're like almost clueless. So the S&P 500, Fidelity 500 Tracker Fund, FXAIX, they do it all for you. They know when to buy, they know when to sell. They know what companies to drop, what companies to add. You don't even have to lift a finger. You just put your money in. Hopefully every month you just keep adding. You get a dividend, okay, you pay taxes on the dividend every quarter. It's true. But you reinvest the dividends. They do it automatically. And you keep it in there for 20, 25, 30 years so you don't pay taxes. It's so simple. Just be careful not to make dumb mistakes like I did. There was a time when I sold a bunch of my FXAIX and like I bought Amazon, and then Amazon was like going sideways for a year. And when a company goes sideways, like it never really goes up or down for a whole year, but the S&P 500 goes up 10 or 20%, well, you just lost 10 or 20%. It's a lot. Okay? And I remember one time I sold it and I bought something called a triple action fund that was like just for day traders, and it would like go 3 times higher than maybe some other fund, and eventually it went to zero. And they closed the fund, and I just lost everything. And it was a lot of money, and it was risky and whatever. I mean, I can understand if you need to sell to buy a house or buy some land or start a business. But I really hope that business does well, because if you start a business and you lose money, then the money that you've lost, like say you started a business and you lose like 50 or 100,000, for whatever reason, bad luck, whatever. Well, that 50 to 100,000 that you could have invested for 30 plus years in the S&P 500 could be like 500,000, like some huge number. I mean, I'm not going to put it in the compound interest calculator, but that's a lot of money at 9% over 30 years. It's like $13 for every dollar, right?